But in addition to that, so once your income goes above that, then you start to pay taxes. But the point I want to make is there's, I think, a really important threshold right around an adjusted gross income of 150 grand, because at that level, again, you get the extra $6,000 deduction for each spouse, so $12,000 total.
And that's for joint couple filing.
Joint. If you're single, it's exactly half that.
75. Okay.
Yeah, 75. But at an AGI of 150, if you subtract out the standard deduction, basically what that means is if your income is under that threshold, then all of your ordinary income basically falls in the lower tax brackets, the 10 and the 12% bracket, and all of your capital gain and dividend income falls in the 0% bracket. So an AGI of 150 is really important. You get all those deductions. Your ordinary income is taxed at low rates, and your capital gain dividend income is tax-free. Once your income goes above 150, you start to lose that $6,000 deduction, starts to get phased out. Your ordinary income starts to go into the 22% tax bracket up from the 12, and your capital gain and dividend income starts to go into the 15% bracket up from the 0. So all three of those things happen right at an AGI about 150.
You know, it's so important. If you're on that cusp and your boss like, oh, you're going to get a raise. No, I don't want a raise. Give me more vacation. Give me something else.
Or put into your 401k.
Put
do
that. Okay,
yeah.
you can do that. Yeah. But if you're, I'm assuming people max out.
Give me the
401k.
raise. And,
Yeah, more. Yeah, with that, don't turn down income. More income is generally going to be better than less income in 99% of the cases. The only case where it's not is like if you trigger Irma, just barely.
Right.
But don't turn down a raise, because hopefully there's something else you can do. You can put it into your 401k. You can try to maybe give a little bit to charity or something. I don't know. There should be ways to hopefully mitigate that. But again, people need to keep that number in mind, because if you're withdrawing from retirement accounts, IRAs, that's taxable. If you're doing Roth conversions, that has an influence on it. If you realize some extra capital gains, that could push your AGI up. So, there's a lot of things to keep in mind as in tax planning when we're trying to structure and lay out how much income you should have.
And that's why we say you're a fee-based planner. Another reason why we always tell people to contact you before they do something. So if they say, hey, I think we get a raise, they need to contact you and say, should I take this raise? What should I do? And you can figure it out, saying you're not adding to your 401k, increase that, or if they are. I mean, all these different things they can do.
Yeah, so take the raise, and then this is how we can, mitigate it. Maybe you were putting money into a Roth account, we'll put more into your pre-tax account so we can stay under that threshold if that makes sense long term, or, whatever it is. So, but yeah, a lot of times people make decisions without fully understanding all the consequences with that decision, and in many cases, it can't be undone.